just going to wrap up the last few little tidbits in this last video. So first thing we're going to discuss is retiring the bonds at maturity. So pretend now we're at the end of 5 years. We've sent our 10th and last interest payment to the bondholders. It doesn't matter if the bonds were issued at face value, a discount, or a premium. We've now amortize the discount or the premium so that the carrying value is always 100,000. So regardless, again, of whether it was a discount or premium, they're now zero. The carrying value is 100,000 on the balance sheet. So when we retire the bond at maturity, all we have to do is pay off that 100,000 now. So remember that bonds payable has been sitting over here with a credit balance of 100,000. We haven't touched the bonds payable account since we issued the bonds 5 years ago. So to pay off the bond payable, I'm going to just debit bond payable, credit cash for 100,000. So it is possible to retire bonds before maturity. We're not going to discuss that in this course, so you don't need to worry about that. We're just going to say this when we did that 10th interest payment, we mailed all the interest checks, and now we're going to stick a second check in there to retire the bonds. Now, let's look at the liabilities section of the balance sheet now that we've covered all of those. So notice that they're going to be split between current and long term. We're going to list all of our current liabilities. Remember, the columns in financial statements do not mean debits and credits. They're there for individual amounts, subtotals, and totals. So we've listed all of our current liabilities, and then we've got the total over here. And now we've listed our all of our long-term liabilities. So we've got our notes payable, our mortgage payable, we've got our bonds. In this case, they were issued at a discount, so we've subtracted the discount. We've put the carrying value here. So we've totaled up our current liabilities and our long-term liabilities, and that gives us our total liabilities here. Now, just a couple of ratios that I want to go over with you real quickly. The first one is called the one that we're going to look at is called the debt to equity ratio. This is measuring what's called financial leverage. How much of your company is financed with debt and how much of your company is financed with equity. I know for individuals, we've always been taught that debt is bad, that you want to have as little debt as possible. That's not necessarily true for corporations. Companies want some debt. They don't want to be all equity financed. The reason is that interest payments on debt are tax deductible to a company. But payments on equity, such as dividends, are not tax deductible. So companies don't want to be all equity financed. They want some debt financing so that they can get that tax deduction with that interest. So if we have a ratio greater than 1, meaning we have more liabilities than equity, so our formula is total liabilities divided by total equity. If we have a ratio greater than 1, that's not necessarily a bad thing. You don't want this ratio to be too high, certainly, but what is too high is going to depend on the size of the company, the age of the company, and the industry that the company's in. So a ratio greater than 1 is, if it was exactly 1, that means debt and equity were equal. If the ratio is less than 1, that means the equities exceed liabilities. That rarely happens in real life. So you're almost always going to see debt to equity ratios greater than 1. Again, you don't want them too high, but in this example of Kohl's at 1.26 and 1.47, certainly that's not too high. That doesn't, if it were a 3, a 4, a 5, and yet everyone else in the industry is sitting at like 1.5 to 2, then we would be concerned. But this is pretty normal for companies.